Your stock market heading south. Live from New York City this morning for our audience worldwide. Good morning, good morning. We're down by more than 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, we begin with the big issue, the bears making a comeback.
The bears are still in charge. 85% of the people I talk to are still bearish.
This to us very much looks like a bear market rally.
Bear market rally.
We're still within that framework.
As bear markets get older, the bear market rallies get larger.
Overall positioning has still been pretty depressed, and sentiment reflects that.
Heading into Jackson Hole.
There's still a lot of work for the Fed to do.
We are still very much in the early days of recovering off of an extreme low.
I don't think these issues have been resolved.
Risk assets are still quite at risk for a hard landing.
You've got to play defense here.
It's still a bear market rally until proven otherwise.
Equity futures down this morning. Joining us now to discuss is Nuveen's Tony Rodriguez, Kathy Jones at Charles Schwab. Kathy, first to you. All looking ahead to Jackson Hole, Wyoming, and Fed Chair Jay Powell on Friday. What are you looking for?
Well, I expect him to talk very tough on inflation. That's the Fed's stance right now, and they don't really have much other choice. Of course, it's easy to do with unemployment at 3.5%. I will see what happens when we get further down the road if we see continued weakening in the economy. But for now, I think that the party line is going to be, we have to keep fighting inflation. We'll keep raising rates. We'll do quantitative tightening until we get close to our 2% target in sight.
A lot of things to talk about. Tony, this is Bank of America. They made some bullet points. They said we need to talk about a slower pace of hikes potentially coming up, restrictive policy, how long will that remain appropriate, the pivot that this market's looking for to rate cuts, will we get some pushback from that, and the risk to the outlook around the incoming data. For you, Tony, what's important? What tops the pile?
Well, good morning, Jonathan. Good to be with you. And I think for us in Nuveen, what tops the pile is really the Fed pivot that's currently being priced into the market in the second quarter. We do think the Fed is going to pivot, but it will at the earliest be in the fourth quarter of next year, could possibly be even pushed off into 2024. So we think that rates are going to be at a higher level, plateauing at a level for longer than what's currently priced into the market. And I think that will have some pretty negative effects on risk assets broadly. So I think that's where the Fed is going to be pushing back the hardest, given how much easing in financial conditions they've seen since the last meeting and since when spreads peaked in fixed income markets back in early July.
That's the 23 divide that we need to talk about through the whole of this week. Kathy, in 2023, a market talking about rate cuts, a Fed discussing raise and hold. I've asked this question a few times in the last week. I'll ask it of you. Raise to what? Hold for how long?
Yeah, we see 50 basis points in September, another 25 by the end of the year, and maybe another 25 after that. 3.25, 3.5 at the upper end of the Fed funds target range. I think that we'll see significant softening in the economy as we go forward. I'm not really sure the market's pricing in a big pivot. You see just a minor kind of pricing of a decline in the spring of next year. That's pretty typical. We've seen the Fed reverse course with maybe a minor rate cut after the peak within 6 to 8 months in the past. That's not an unusual pattern, but I wouldn't say the bond market's really pricing in a huge pivot here. But yeah, 3.25 to 3.5 at the upper end, staying there until they start to see the inflation numbers come down.
Yields are climbing this morning at the front end, up by 7 or 8 basis points to 330. Let's call it 331 on a 2-year. Equities breaking down by about 1.2% on the S&P 500. Gas prices in Europe absolutely surging. We'll bring you a lot of news on that in just a moment. Euro dollar breaking down in and around parity through most of this morning. Mike McKee, Chairman Powell, has got a lot to discuss in Jackson Hole, Wyoming this week.
He does. And you look at what the economic indicators are. Tomorrow we'll get some of those PMIs that will have an effect maybe in the markets, particularly in Europe, and parity for the euro. But Friday's the big day with the PCE inflation number. Going to be very interesting because the question we have going into Friday in Jackson Hole is how far, how fast. That's what your guests are talking about. What's the Fed going to do? And for the answer, we turn to the hostess with the mostest, Esther George. She's going to be hosting the conference out there. And this is what she said last week. How far do you raise rates? I don't think we're going to know. We're not going to know until we begin to see how some of these variables come together. And I'll follow that with a quote from Jay Powell. These are not normal times. In June, the Fed thought we would see a terminal rate somewhere around 3.8% next year. Since then, we've seen jobs jump, inflation fall a little bit, supply chains ease, but the Russian war continues. Inflation pressures are pretty broad. We don't know what is going to happen. So the question is, what does Jay Powell say about it? Not much he can say. He can talk maybe about the long term, but he really isn't going to have any answers for September 21st, the next Fed meeting. He speaks Friday at 10, but the August jobs report is September 2nd, and the CPI report is September 13th. So I'm not really sure if the markets are going to get what they want out of this, but the way things have gone this summer, they'll probably make it what they want, depending on their view of what he says.
It's a long road to September. Mike, just on Europe and the global story, how is he going to navigate that this week? China's slowing down. Europe, and I don't want to lay it on too thick because it has some really, really serious problems, but it's a mess right now, Mike, in a big, big way. Do they have to confront that mess?
He won't confront it in person, I don't think, or publicly. He'll talk about the fact that there's a lot of uncertainty in Europe, maybe. But you've got Isabel Schnabel going to be speaking at Jackson Hole, and she's going to represent the ECB. So I don't think he'll take on the ECB directly in that sense. But obviously, it weighs on everything that happens around the world.
That weaker euro is not helping Europe, that's for sure. Mike McKee, thank you, especially given the inflation dynamic for the Europeans and for the UK, for that matter, as well. Euro dollar breaking down this morning. The ECB meeting September 8th. We're expecting another 50 basis point rate hike into potentially an energy crisis and a recession. Year end, just some unbelievable stuff. Max Kettner of HSBC, we know he's maximum underweight equities. Max underweight is something he's talked about for a couple of weeks. This is Max Kettner. He's now talking about the potential to buy developed market sovereign debt. And here's the why. Our leading cyclical indicators all point to more broad-based weakness in the second half, with warning signs flashing for the housing market, for the consumer, and also increasingly for labour markets. We'd likely add to DM sovereigns before sounding the all clear on risk assets. Kathy, Tony, I want to throw that at you. Tony, first to you. We'd likely add to DM sovereigns before sounding the all clear on risk assets. Would you agree?
Well, Jonathan, from the perspective that I think that comment comes from, which is looking at broader capital markets, including equity markets, then yes, we would agree. We do think that there is more downside in broader risk assets, but that includes equity. So from an equity allocation perspective, we do think that an allocation to broader fixed income, DM sovereigns included, makes some sense. And we do think that as we move into next year, use the technical term for Europe about it being a mess. We do think Europe is going to really face some very strong headwinds the rest of this year and next year. So that ultimately does put a little bit of a cap on where rates are going to be and makes the potential for, I think, reasonable returns out of DM sovereigns.
Kathy, what's your take?
Yeah, we've liked DM sovereigns as yields have moved up this year. We've been extending duration and high quality bonds, and that obviously includes DM sovereigns. And I think that the story is pretty straightforward. As the Fed tightens, as other central banks tighten into a slowing economy, that's going to give us a slower growth and lower inflation, higher risk of recession. That's when you want to own high quality sovereign bonds. And we like the U.S. better than Europe, probably most strongly because of the strength of the dollar. But we do think that the upper end of the potential for long-term yields is pretty close.
Hey, Kathy, with that in mind, where does the QT effort fit in here, given what we're discussing?
Yeah, QT is going to be a real issue for the Fed because, it's going to add to the tightening, and you have the MBS problem. Will they have actual outright sales of MBS at some stage of the game. So you have the combination of rising rates around the world plus QT, which is really going to step up in September, adding to that decline in liquidity. I think that it's going to be tough for the Fed to continue QT over the long run as they plan, because at some point they're going to have to ease policy, and it wouldn't make sense to be tightening via QT and easing via rate cuts, in the second half of next year. So they may get the balance sheet down some, but I don't think they'll get it down as much as they're planning to.
Tony, do we need to get realistic about how much they can achieve on the QT front?
Yeah, I think we do. I think Kathy's right. I don't think they're going to be able to push it all the way through 2024. We don't think that the first ease is going to come till very late 23 or early 24. So next year, you should get somewhere in the neighborhood of $1 trillion or more of a reduction in the balance sheet. But ultimately, what the QT will serve to do is allow the Fed to not have to go to as high a peak funds rate. So that's why we think that a 4 handle on the peak funds rate is unlikely and is more likely to be 3.5, 3/4, or 3 3/4 to 4% at the highest, because of the additional tightening coming from the QT side of the equation.
Tony, Kathy, sticking with us. Equities breaking down a little bit, off by 1.2% on the S&P 500. Yields up at the front end, 10's basically unchanged through most of this morning. They're higher by 2 basis points on a 10-year, just short of 3%. Your 2-year yield up 8 basis points to about 331. The epicenter of the price action this morning in the gas market, in the commodity market over in Europe, gas prices up by 20%. Or so through most of this morning. That's some of the price action. Let's get you some movers into the open. Let's say hey to Taylor Riggs. Hey, Taylor.
John, you mentioned the bond yields. This is actually an interesting story when you think about yields higher. We know that the basic math means that present value of some of those long duration assets falls. That's sort of the macro story around Apple, around Nvidia. Of course, as you see big tech leading a little bit of this sell-off today. The sort of micro factors, our BI analysts had a great note out about Apple saying they like the iPhone 14, but of course, maybe not a lot to move the needle, at least in the short term. Nvidia, of course, will get quarterly results from them on Wednesday. I guess we're doing memes again, John. I know we did Bed Bath & Beyond a lot last week. AMC falling now 36%. As you think a little bit just about the unwind of some of those sort of big FOMO assets, YOLO assets, if you will. Finally, another sort of fundamental stock here, Signify Health. Take a look at this. You're up 41%. We have reports that United Health, Amazon, CVS Health, all really vying here to buy out this healthcare technology provider. So a lot of fundamental and maybe not fundamental news as well this morning.
There's a big move. Taylor with us through the hour. Lucky to have her. Taylor Riggs with us through the opening bell. Coming up, Europe's summer of discontent.
They're in recession already. A turnaround probably will come at some point next year, but we've got to get through the worst of it first. So things are a real mess. There's no growth momentum anywhere in Europe.
Surging energy prices, record inflation. It is not a pretty picture. That picture up next.
They're in recession already. A turnaround probably will come at some point next year, but we've got to get through the worst of it first. So things are a real mess. There's no growth momentum anywhere in Europe. The only place where I can see any growth momentum coming through before the end of the year is probably in the US, and even there it's going to be patchy, but it's nowhere near as bad as it is in Europe.
Surging prices in Europe and strikes in the UK. The Bundesbank's chief saying in an interview the following: if the energy crisis worsens, a recession seems likely next winter. The economic prospects for the second half could deteriorate further. In the UK, 2,000 workers at the country's largest container port going on strike. The British Ports Association CEO weighing in.
It is a kind of issue for the logistics industry and the freight industry and the shipping sector here in the UK. The issue is if you do reroute freight away from its traditional travel plans, etc., there will be a cost, and those costs will be passed on to importers, traders, and potentially ultimately consumers.
The team coverage starts right now with Birgit Jennen in Berlin and Lizzie Burden over in the UK. Lizzie, let's start right there. The strikes in the UK, just how bad are they getting?
Well, Well, John, it's a significant moment in the UK's summer of strikes. The unions have picked Felixstowe to send off a message because it's the UK's biggest container port. You've got an 8-day strike, 2,000 workers. They say they're not going home until they get a 10% pay rise because you've got double-digit inflation here in the UK, but it's going to be disruptive. There's an estimate from the Russell Group that it's going to affect $800 million worth of trade. Maersk's already had to reroute 3 ships. It's monitoring 11 more. Port officials say the port's running at 10% capacity, if that. But the whole point of it, when you ask the strikers on the picket line, is to create disruption. The risk, though, is that they add to the wage price spiral and that the unions add to inflation that they're trying to shield their workers from.
We've got disruption in the UK and real disruption in Europe as well. Looking at gas prices up by close to 20%. Birgit, can you tell me just exactly what is set to happen with Nord Stream 1 at the end of this month and when we should expect it to come back online?
Well, I mean, Nord Stream 1 is sort of running. I mean, it is running currently at 20%. The government is, on the one hand, planning with this reduced capacity and has to basically is filling up the storage. So they are looking, especially now for the winter, because they do need some extra energy, some extra gas, and they are somewhat scrambling. They are looking to Canada, they are looking to Norway, and to Qatar, basically to provide some extra LNG or gas. But so far, the negotiations are sort of at a deadlock. And so the government is really looking at some extra, some keeping, for example, nuclear also still running, at least for a certain time.
Birgit, good to catch up. Birgit Jennen there out of Berlin. Lizzie Burden in the UK at Felixstowe. The latest on Nord Stream 1, the pipeline will stop for 3 days for maintenance at the end of this month. And the big question I think a lot of people have is, will it come back online? That's why you see that fear in gas prices this morning. Gas prices up 19% over the last 30 days, up close to 80%. That's how bad things have been on the gas price front. Tony, Kathy, back with us. Kathy, it just seems to me that we're seeing this news. It's clear and obvious. Ian Shepherdson of Pantheon Macroeconomics was on the programme with us earlier this morning on Bloomberg Surveillance, and he said if you're not expecting recession in Europe, you've not been paying attention. Kathy, I'm just wondering whether you're seeing it priced adequately for what we're discussing right now.
You know, I think that there's further downside risk in risk assets in developed markets in general. Obviously, Europe, with the euro dropping to parity, is reflecting a lot of that risk. But I do think there's more to come. And I think in the U.S., we can't simply stand back and say, well, everything's bad elsewhere, but we're going to be fine. And again, I get back to this global central bank tightening into a declining, weakening global economy. I don't know how that's sustainable over the long run. We'll probably see risk assets decline and central banks back off at some stage of the game. But I don't know how much pain we have to suffer first before that happens.
Tony, it reminds me of the conversations we had maybe 10 years ago when we talk about the European debt crisis and ask ourselves whether the US economy could decouple from the rest of the world. Do you think the US can decouple from what we're seeing play out in Europe, or is it part of the same story?
So, Jonathan, I do think the stories are related, and I don't think the U.S. can decouple. And in addition to Europe, which I think is certainly the poster child for the broad economic weakness that we're seeing this year and next, but you also have China, which is clearly suffering quite a bit, not going to meet any of their growth targets. People have reduced their forecast there to 3%. A lot of folks have them growing actually below that. So when you put together a European recession, a very slow growth, recession-like environment in China, very difficult for the U.S. to avoid that, particularly in the context of a high inflation environment that central bankers do need to respond to try to create some demand destruction to bring those numbers down. So the disconnect right now in our mind is not necessarily with where rates are, it is with where spreads are. The recovery we've seen since early July, we think is a little optimistic with respect to risk asset pricing.
Tony, is that both IG and high yield, or one or the other?
It is both. We think that there's more downside, obviously, just from the math of it for high yield. We saw, spreads come in 160 to 180 basis points. We think we could retrace at least half of that into the fall here. Whether we get back to the peaks of early July will depend a lot on how the data plays out with respect to both growth and inflation, and therefore the monetary policy response. But we do think there'll be weakness across both IG and high yield.
Kathy, are you on the same page?
Yeah, we're especially cautious on high yield and have been for a while. Like Tony, we haven't really bought into this tightening in spreads that we've seen recently. I think it's premature. And in fact, we do expect high yield to widen quite a bit. Less so in IG. I think the fundamentals are still pretty decent there. And we do see value in the sort of intermediate term area of the IG market. But certainly rates can back up, spreads can widen. And again, the more aggressive the Fed is in fighting inflation, the more downside there is in the economy, the more we'll see spread widening.
Can I do a quick yes or no with both of you? Do you think we get rate cuts in 2023? Tony, just a quick yes or no.
Very late 23, yes.
Kathy?
Yes.
Interesting. That's the big debate right now into 23. The Fed's not going to touch that one, I don't think, anytime soon. Kathy Jones, Tony Rodriguez, to the both of you. Big debate for me as well, is we keep talking about peak inflation in the United States, peak year-over-year inflation. It's going to come down. In the UK and Europe, we're talking about the potential for peak inflation still to be far out into the future. Citi this morning factored in higher gas and electricity prices in the UK and came up with this number. This is their forecast. We now expect CPI inflation to peak at over 18% in January in the United Kingdom. That is a monster call. That's from the team at Citi a little bit earlier this morning. We've got equities down this morning. Up next, we'll bring you the morning calls and later a different perspective on things. TPW's Jay Poloski seeing large cash piles to fuel further gains in equities. More on that around the opening bell. From New York, this is Bloomberg. Equities down, yields up at the front end, and the euro's trying to hold on to parity with gas prices absolutely surging. Here's the picture of things going into the opening bell in New York this morning, and good morning to you. We are negative by more than 1% on the S&P. On the Nasdaq 100, we're down by 1.5. That's the price action. Here are your morning calls. First up, CFRA downgrading Netflix to sell, 238 price target, saying shares will underperform the S&P after rallying 40% from July lows. Barclays upgrading Foot Locker to equal weight, expecting the newly appointed CEO to accelerate the retailer's turnaround strategy. And finally, Evercore downgrading UPS to inline, 214 price target, seeing limited upside given the stock's stretched valuation and continuing economic uncertainty. That stock down by 1.4%. Coming up, making a case for investing outside the United States. TPW's Jay Poloski adding exposure to emerging markets, buying both equities and debt. A more constructive view coming up around the opening bell. From New York, this is Bloomberg. We snapped a 4-week winning streak on the S&P 500 last week. Real weakness to close out the week on Friday. It spills into this week, this Monday morning. Good morning to you. Equity futures down about 1.2% on the S&P 500. On the Nasdaq, we're down by close to 1.5. A similar move on a Russell on the small caps. There's your opening bow. Switch on the board and get to the bond market. Yields higher at the front end. Your 10-year creeping higher too by a couple of basis points to 2.99, just short of 3%. Trouble in Europe. That's not news, is it? You're familiar with it. Gas prices absolutely surging in Europe, up by about 18% on my screen right now. Euro dollar struggling to hold on to parity. A break of that level a few times already this morning. Euro dollar right now 1.0004, a negative a third of 1%. Crude taking a dive in the last hour or so, down by 2.6%, $88 and about 40 cents. About 30 seconds into this one, let's get you some movers. We can welcome back Katie Greifeld.
Let's start with Signify because shares absolutely surging this morning as its bidding war heats up. You now have United Health and Amazon said to have thrown their hats in the ring. That's in addition to the likes of CVS. Now, United Health reportedly has the highest bid at $30 per share, stock surging by about 40%. Not as much left for Microsoft. It's falling along with most of big tech this morning. Valuations, of course, in focus this week as we count down to Jackson Hole. Microsoft on track for a 5th day of losses. And you can see Ford also under pressure. That's after after a Georgia jury ordered the company to pay more than $1.7 billion over a 2014 rollover incident. The company does plan to contest that, but still shares off by about 4.5%. And finally, Royal Caribbean, just one of several travel stocks lower this morning. That sector broadly being dragged by those economic slowdown fears that we've seen in the bond market, John.
I will not comment on the stock, but you all know how I feel about cruises. Just throwing that out there. Again, Katie, good to see you. Thank you. About 1:30 into this one, we are down by more than 1% on the S&P 500. Every single industry group is trading in negative territory. The relative outperformance coming from staples, healthcare, utilities. That's a defensive picture for you. The underperformance from discretionary down by about 1.6%. The communication names down by 1.5%. The industrials down by 1.5%. The financials down by 1.5%. Information technology down by 1.3%. Energy down by about 1 full percentage point. The summer rally increasingly under attack over the last couple of days. A reversal of fortune for some of July's top performers, with big tech and meme stocks extending their August declines. With more, here's Taylor.
I hope you feel better about meme stocks than you do about cruises, John, because they're going to need all the help they can get. I just want to bring you a headline. Crossing the terminal, AMC Entertainment dropping 38% at the open, the most since June of 2021. So, and indeed, a big reversal as we see it now, pretty much all the way across the board. I want to talk about AMC specifically because APE begins trading today. APE, we know it. Remember, back in early August, AMC declared a special dividend in the form of APE. We're calling those the AMC Preferred Equity Units. One of those was distributed for each share of AMC Class A common stock. So all of this begins trading under the ticker APE, APE, that begins today. So that's some of the fundamental news as we think about AMC Entertainment versus some of the other preferred equity shares as well. But overall, as you can see, it's been a big decline. You had a huge run up in early 2021, the summer, and then, of course, today looking at some of the biggest declines that we haven't seen since about June 2021. So really all about perspective here when we think about sort of the intraday, intra-week volatility and that long-term perspective, too.
I just mean, Taylor, that if you go away, you should be getting away from people, not being trapped on a boat seeing the same people every single time. You ever done a cruise?
So you don't like memes more than cruise lines?
No, I'm indifferent to memes. People can do whatever they want with their money. I just mean, for me personally, this is what I would do with mine. Not go on a cruise. That's all.
Here I thought you were just so friendly, John.
I am.
Just don't want to be
with
trapped
the people
with
that I
on a
choose
boat.
to be friendly with, and, you know, you bump in. Anyway, Taylor, thank you. Taylor Ricks. Call for caution mounting. You know the story. The Bears making a bit of a comeback over the last couple of days. Stocks down and down hard last week too. We ended the week in a very, very weak way. And Katie Lyons, we snapped that weekly winning streak of the summer so far.
Yeah, is the long, hot summer for this equity market finally coming to an end, John? That is the question, as everybody seems to be talking about autumn all of a sudden, and it's August 22nd. So I'd like to cool that talk, but really dissecting this rally is what everybody is doing right now, because August and July have been really, really strong. Actually, one of the best summers for the S&P 500 on record, with a rally of near 13% through Friday. But of course, we are seeing those gains being snapped today. And if you ask David Kostin over at Goldman Sachs, he will tell you the rally is unlikely to extend any farther. He thinks that renewed fears of an economic slowdown will almost surely undo the recent gains. And he says the S&P could actually fall to 3150 in the event of a recession, which would be a drop of more than a quarter from Friday's close. Plus, he's taking a look at valuations, and his view is if inflation surprises to the upside and the Fed tightens more aggressively than expected, those multiples are likely to compress. And in the latest MLife poll survey, we also see echoes of that thinking. 68% of respondents expect price pressures to erode margins and send stocks lower. A lot of the respondents in that survey also expect that the sell-off in bonds is going to continue. And the pressure across those two assets has Morgan Stanley now saying, go to cash. Andrew Sheets and the team there say their forecast for cross-asset returns globally are low, squeezed by tighter policy if economic data holds up, and if data rolls over, higher risk premiums. At the same time, cash yields have risen sharply. He pointing out the yield on 6-month T-bills right now 3.1%, which is the highest going back to 2007, John.
Kelly, I blame Tom for this. Where did this chat about the fall come from?
I hadn't heard anyone talking about fall until Tom did it. So
just
blame
TK.
Tom.
Why do we wish away the summer in the United States? Why is that a thing?
I don't know. People get tired of the heat, and then they forget how much they hate the cold.
Exactly. And then we have to get used to it for about 4 or 5 months in New York. Kelly, thank you. Kelly Lyons. I blame TK for everything. TPW's Jay Pawlowski saying the Fed will get inflation under control, but the goalposts will shift. Here's one for you. The Fed can take comfort from aggressive fiscal tightening in the US, coupled with very well-anchored inflation expectations, to declare victory with inflation at 3%. rather than driving it down to 2%. I'm very pleased to say that I get to catch up with a good friend, Jay Pawlowski at TPW, because it's been a while. Jay, fantastic to catch up, sir. And I know you're going to give us all a very different perspective away from the gloom and doom that we've experienced through the last few hours. So let's start here. You think there's a surprise in store. You think it's a positive one because you think inflation is going to come down a whole lot more quickly than some people. Why is that, Jay?
Well, I think we've already started, John. And by the way, it's great to see you as well. And I agree with you on the cruise front. I think we've already started on the inflation, right? The drop from June to July was the fastest in 20 years. I see no reason why that's not going to continue, particularly on the transitory front. Gasoline prices, supply chain woes, used car prices, all those things continue to decline rapidly. So I think that's quite likely. And then, of course, we get to the core issues of labor and housing. And there, I think it's obviously going to be a little bit slower. But on both fronts, I expect labor pressures to ease and wage gains to ease, particularly as the quit ratio goes away. People get more nervous, less likely to quit jobs. Those are the people who are getting the highest wage gains. Those are the people pushing up the average hourly earnings. And then on the housing front, I mean, the data is pretty clear. You've had complete collapse in mortgage applications, 20-year low in housing starts. So I think the pressure on the inflation front, to me, is much less. And I expect the Fed to end the aggressive front loading that has been the story of 2022 in September. It'll be 75 bips. It'll be the last 75 bips. We're going to downshift. And over time, I expect the Fed to validate the high nominal growth world that we're in, Jay, not try to eradicate it.
Let's unpack some of that. 75 down to, say, 50 to 25. And where do you see Fed funds ultimately ending?
Yeah, I mean, I think it's more the journey than the destination, John, particularly for markets. I'm a believer that markets bottomed when inflation peaks. I think we're in an environment like the 70s and 80s, not 2001, not 2008. And so to me, the market has bottomed, and the market is discounting the likely direction of interest rates. If interest rates inflation surprises and comes down faster than expected, the market is not going to go further south. It's going to go north.
Jay, is that surprise, though, and to put you on the spot, as you unpacked why inflation would roll over, is that surprise driven primarily by the demand side having a problem or the supply side providing a solution?
I think it's more the latter than the former, John. I mean, it's pretty clear. You look at almost any supply chain, supply side indicator, and they're all flashing pretty much close to normal. I think we're coming out of the crisis, ahistorical years of 20 to 22. We're moving into something a little bit more normal. The market is saying normal is pre-COVID. I'm saying normal, the new normal is a high nominal growth world. The Fed is going to validate it, declare victory at 3%. That's underpinned by a global capex boom to deal with the 3 C's of COVID, climate, and conflict. Look at the climate bill, look at the CHIPS Act, look at the next gen Fit for 55 in Europe. There's a tremendous amount of cap expenditure that's going to take place over the next couple of years. It's going to support growth and going to support earnings and going to support, I think, in particular, John, I tend to like Europe. I think the big play is in emerging markets. I'm focusing much more intently on EM in this latest cycle.
Well, you like China and you like Asia high yield, and I've got to go there. Help me understand that, given the exposure to the Chinese housing market.
Absolutely beautiful, spot on, John, because here's the funny thing, right? Every day over the last week or two has been filled with headlines about collapse in China housing, collapse in China property. Guess what? That Asian high yield ETF is up. Guess what? Over the last 2 weeks, it's the 4th best performer in my global multi-asset model portfolio, which includes about 28 different ETFs. It's number 4, okay, because the market is ahead of the headlines. It understands that, as we've seen just in the last 24, 48 hours, China's government is drawing a line under the property sector. It's too important, too socially divisive. They've put in a bailout fund. They've cut mortgage rates. The mortgage rate for a mortgage in China, John, is 100 basis points below that in the United States. Typically, if you can get a mortgage in an emerging market economy, it costs multiples of what it costs in the U.S. So I think China bottomed in April and May. The K-Web bottomed back in April. Innovation stocks in the U.S. bottomed in early June. They're not going back to those levels.
Jay, you've got to hope, though, that the policy works. And that's going to be the different way, I think, a split. The people on the other side to this trade will look at things. They'll say, OK, they've made a move, but I don't think this is going to work. I think we've got a balance sheet recession, potentially that kind of dynamic grip in the economy, a liquidity trap, so to speak, that the Chinese are going to be confronting in the next several quarters. Jay, why would you push back against that in a world where Goldman are now looking for something around 3% on GDP growth in China, which, let's face it, that's a recession for Chinese growth. Nomura at 2.8%, Jay. Why is the market right? And let's face it also, it wouldn't be the first time the market has sleptwalk into a problem.
Yeah, well, I'm an old Morgan Stanley guy, John, so I immediately discount Goldman Sachs. Flat out, right off.
You've got to give me something more than that, Jay. Come on.
No, I'm ready. I just wanted to let you know that. No, I think, look, those people are already out of this. That's the point. They're out. I mean, we've been talking about property in Asia, John, in China for a year. Remember, last August, September was Evergrande. It's been a full year. There's nobody invested in China who is worried about property. That's why this Asia high yield ETF, which is 30% China property, is going up in all these horrible headlines. That's the market telling you that there's no more sellers. And people are starting to nibble because they think the government's got a shot at fixing the problem. And China has, I think, a much greater capacity to fix problems than many other economies because it's a state-directed economy. That doesn't mean they get it right all the time, but that means they can put a lot of effort behind it. And I think they're just starting to do that. Second half comps, year over year, very easy for China. I think China will grow somewhere around 4% annualized in the second half of the year. That's way better than pretty much anywhere else. And by the way, they're pumping money. Take a look at the M2 growth rate in China. Their M2 is growing about 11, 12%. The credit impulse is turning up. China is starting to emerge from lockdowns. And let's remember, those lockdowns were 6-9 months ago for China. It's a demand issue, not a supply issue. As they move away from the very tight lockdowns, which I think they're doing, you're going to get better demand. And to me, China is a recovery story. And it means we have a desynchronized global economy. U.S. and Europe slowing, China and Asia picking up. And I think that's healthy for the balance of the global economy.
If James Gorman's watching, I'm sure he's smiling, Jay Pawlowski, because he knows you've been dead serious and you weren't joking. Jay Pawlowski is sticking with us. Coming up, headwinds growing for the UK.
There are those underlying issues, strikes, there's a big UK current account deficit. So there are all those woes facing the UK that you think, well, maybe it's not very easy to be too constructive.
Sterling weaker, the euro weaker, the dollar a whole lot stronger. That conversation up next.
There are those underlying issues, strikes, there's a big UK current account deficit. So there are all those woes facing the UK that you think, well, maybe it's not very easy to be too constructive. And of course, the potential effect of that is if you've got a weak pound, that's going to push up further on UK inflation. So I'm afraid it's hard to tell a very optimistic story there.
The pound is weaker this morning, very briefly breaking through 118, a 117 handle on cable. Briefly, 117.82 at the lows, right now 118.05. Sterling's weaker, the situation in the UK getting worse and not better. The dollar getting a whole lot stronger. Guy Johnson out of London for more. Guy, you'll be leading the show in about 13 minutes' time. I've got no doubt this is going to be a big feature.
It's absolutely front and centre right now, and it's interesting the disconnect that is existing right now between what is happening in the States, very much focused on what's happening with Jackson Hole, and Europe, very much focused on what is happening with this energy crisis. John, we've got PMI data coming out of tomorrow from the Eurozone. Take a look at that. That could be a real catalyst. A lot of people are basically switching off, tuning out, waiting for Friday, waiting for that Powell speech. I think this European narrative is going to get more aggressive. I think it's going to get much more aggressive as we head into September. But we've now got this city call. Maybe that's a little bit of grandstanding. But the talk of 18% inflation is going to be a wake-up call for a lot of people. And that means that we're in a position now where you could have RPI, which is train fares and student loans, being well north of 20%. John, this is alarming to say the least. How isolated can the US be in this environment, I think, is a really key question. I heard you talking to Jay just about this a moment ago. What's happening in Europe, what's happening in the United States versus China. It'll be interesting to see how isolated the US can make itself from what could be Europe hitting a brick wall in a big way this winter.
Guy, I'm with you. This is problematic to say the least. September 8th is an ECB meeting. Guy, we're still expecting them to hike 50 basis points into this.
So it's interesting. So I'm fascinated to hear what Isabel Schnabel says at Jackson Hole, John. What she's talking about, what the tone is from the speech that she's going to be delivering, what she's going to be saying there. The expectation is that, yes, we are going to get 50 basis points. The question is, where do we go from there? Are these central banks going to be able to continue to hike into this kind of weakness? She's talked about that already. She's talked about hiking into a recession. I think September increasingly looks like it's nailed on. But if you continue to see very high primary inflation leading to secondary inflation, which in the Eurozone in particular is very sticky, John, the central bank may have no choice but to continue, but for how long is the key question. How big is this downturn going to be? How much industrial destruction are we going to see with German electricity prices today north of 700 megawatts an hour and gas prices up, circa 15% right now?
Brutal, just brutal. And I've used that word so many times to describe Europe this year, and Guy, it gets more brutal. Guy Johnson out of London, he'll lead the programme at around about 10 a.m. Eastern time, and he'll guide you through the European close. Sterling, right now, a break of 118, 117.95. Euro dollar, a break of parity. We caught up with Jordan Rochester of Nomura a little bit earlier this morning. Take a listen.
It has been mostly a dollar story. Euro hasn't underperformed as much as I think it should. I think the FX market is totally mispricing the situation in Europe. The situation is a complete rethink of the economic model in the Eurozone. And it's strange for all of us to see the Euro selling off so slowly. I think it should be much faster. We'll be testing 97.50 down towards 95 cents in the next few months.
Jay, you get final word here. Jay Pawlowski at TPW back with us. Europe is looking difficult. The story's ugly. What's the price of the story?
Yeah, I think it's to a large part already priced in. Here's a couple of data points for you. One, German equity selling at a 30-year relative low. So yes, Germany has to recast its economic model, selling at a 30-year relative low discount to the rest of Europe on a PE basis. Here's another data point or two. Second quarter earnings in Europe. Earnings up double digits, about 15% year over year. Sales growth up about 30% year over year. I know that's Q2. I know most of it's nominal. But when you look forward, John, I think a recession is already in the price. And I think, look, this is the downside for Europe is the energy issue, but it's also the upside because this is something that is going to be clarified in a matter of months. And if you look at the German storage information, they hit their September 1st target 2 weeks early. They're likely to do everything possible, including keeping their nuclear plants open to make sure they have power and energy for the winter. And then I think the market will discount this very, very quickly. So if you, my view continues to be, if you're a strategic buyer, i.e. 3, 5, 7 years, and I was just in Mexico talking to all the Afores, all the pension funds, this is an ideal time to allocate towards Europe. Currency at parity, stocks super cheap, horrible story, near-term horrible story. 6 months from now, we could be talking about a very different situation in Europe.
I got 20 seconds on the clock. Would you buy this weakness stateside? We're down 1.5%.
Yes, I think we should buy the dip in large part because I think inflation is going to roll over faster than people think. Fed will validate the high nominal growth world. Earnings bridge provides a support in the interim. Tons of cash on the sidelines. I don't think we go back and come anywhere close to testing the lows of June.
Jay, this was far too constructive. It's good to see you. Jay Pawlowski at TPW. Jay, thank you. People say there's too much doom and gloom out there. Dial 1-800-Pawlowski and you'll get the other side of things very quickly. Equities down 1.5% on the S&P. Up next, your trading diary from New York City. This is Bloomberg. 25 minutes into the session, tough start to the week. Let's put it that way. We're down 1.4% on the S&P 500. Yields up at the front end. The dollar striking through the euro, through sterling. Euro dollar beneath parity briefly. Cable south of 118. Just some of the things to think about this morning. That's some of the price action. Here's your trading diary. Minneapolis Fed President Neil Kashkari speaking tomorrow. Look out for that. We'll get some retail earnings from Macy's reporting results later on this week. We get US GDP and another round of jobless claims on Thursday. Jackson Hole kicking off. We'll hear from Chairman Powell on Friday. Ton of data to end the week as well. Got a host of data, including new Mitch survey, PCE deflator, and personal income and spending data as well. A lot still to come. Looking forward to guiding you through it. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.